Looking at the main headlines, it's disaster everywhere. Hedge funds cut stock leverage at the fastest pace since the 2020 crash. The Evergrande crisis is worsening as defaults are piling up. China's property market is melting down. China home sales hover near an 8-year low. A former People's Bank of China advisor says that the China property recovery is up to a year away. Banks continue to avoid risky companies as home loan sales falls. China developers' shares have fallen the most in 9 months. It's now critically important to know where the structural safety nets are inside market action. All markets are intercorrelated and interconnected. They all influence each other. In this video, I'm going to take you through the key structural areas on the Tier 1, Tier 2 and Tier 3 charts, so you can know where smart money is buying and selling. This knowledge is incredibly important in times of economic turbulence. Let's run the numbers. When people first get into financial markets, the sheer volume of information is overwhelming. Little by little, they understand that everything is interconnected. You can't change one thing inside an economic system without impacting something else. In finance, everything impacts everything else. Professionals know this, and they use this advantage to their favor by stacking probabilities. They look for the canaries in the coal mine. They're always seeking to gain an edge. Financial markets are incredibly and inherently complex. They are not simple. This channel and what we cover is from a professional level. We do not subscribe to retail thinking, trading and investing. Retail traders and investors lose money, professionals make money. But professionals do so in a very specific way. They understand the market pulse. They know where smart money is buying and selling. They use price reality, not stories and not news headlines to dictate if they enter or exit positions. They're aware of the news, but they're also aware the news is sensationalistic. Therefore, they have many rules. They always seek to get onto the right side of the percentage, and they are prepared and not scared. They're informed. The Tier 1 charts represent the engine of financial markets globally, and part of that is the VIX. You can see that the VIX came up to a structural sell area and was rejected. That's a very strong structural sell area, and it's indicated through the TradingView indicator for the VIX, which is available through the CTKS method monthly service. The issue to understand when we look at Bitcoin and the S&P 500, the S&P 500 is the white line, Bitcoin is the gold line. If I was to invert these two lines and look at the VIX, please let me know in the comments, what does the VIX tell you? If the VIX goes up, what do you expect Bitcoin to do, and what do you expect the S&P 500 to do? And therefore, by definition, what do you expect the Dow, the Nasdaq and the Russell to do, and the ASX to do as well? And the FTSE? Inside the masterclass, we're dedicated to a thing called active learning. Active learning is where you just jot down a comment with your thoughts. It's all about learning from the market. The CTKS method is the world's most powerful methodology, standards-based method for determining smart money buy and sell levels, and you can see the method identified this area from 1739 to 1817. This is by marking up the VIX since 1990. Without an understanding of CTKS structure, professionals just don't know where the strength is inside financial markets. We use the VIX to understand what can happen to the stock market, commodities and crypto, and of course also currencies. Why is it important to know what happens to the S&P 500? Say you're an investor in Tesla. You need to know what's happening with the S&P 500, therefore you must know what's happening with the VIX. Here you can see the white line is the S&P 500. The S&P 500 is showing weakness. It's not at all surprising that Tesla is showing weakness as well. All markets are intercorrelated and interconnected. Perhaps you're into Bitcoin and crypto. Maybe you're buying Solana, Link, Bitcoin Cash, or something else. The issue here, junk bonds, you can see that junk bonds, the way that they move influences crypto. This gold line is of course Bitcoin. How does it look for the S&P 500? You can see that white line there. Junk bonds is a very good risk on or risk off indicator. This is exactly how professionals stack probabilities. But it all comes down to structural levels. Yesterday, we looked at the S&P 500, and the structure of the S&P 500 has been marked up since 1871 with the CTKS method. I mentioned in yesterday's video, we lost this key support, and that was a very, very strong support level when price was above it, from 44.19 to 44.40. When we lost that level, it meant the price was coming down to the next structural area, from 43.55 to 43.75. If it's not going above, it's going below. The good news is that we have quite a lot of structure underneath the S&P 500 at the moment, from 42.57 to 43.15. It's very encouraging that it just mildly dipped into it and then was rejected. The buyers have come back into the market. It's also important to understand that the Nasdaq and the S&P 500 tend to follow each other. I've just cursorily gone through the S&P 500, the Nasdaq, the VIX, Bitcoin, and junk bonds. Most traders and investors don't even look at these things, especially if they're in another sector, perhaps commodities, or just trading Forex, but everything is interconnected. Most stock market traders and investors, as well as crypto and commodities, wouldn't even bother looking at the US 2-year yield or the 10-year, but that's a huge mistake. The question is, why is it a mistake? Because the inverted 2-year yield gives you a bit of a dimension as to where the S&P 500 and therefore all the other major indices all around the world and therefore the stocks could go. And where stocks and major indices are going, crypto is going as well. For the subscribers who have the CTKS method monthly service, if you pop on the indicator, you'll notice that there's a fresh air gap above the current 2-year yield. That could mean that the yields could spike up without very little trouble at all. Please let me know in the comments, just as an active learning exercise. If the yields spike up, what do you think this would do to the stock market? And what would it do to especially gold? Yesterday, when we looked at the DXY, it was looking like this, and I said we've got to be really careful because if the DXY gathers strength, it's going to go up very, very quickly, but then encounter resistance. Now, how did I know that? What did I know that other people didn't know? It was literally just CTKS structure. Let's pop on the indicator. This indicator is marked up with the standards-based approach of the CTKS method since 1967. These are not random lines that have been drawn on a chart. That's a standards-based methodology that you're looking at. And when we saw the DXY getting over this particular 105.6385 level, it could move up very quickly because there was not much structural resistance at play until we got up to 106.0824. And what happened then? The structure inside the market has been pushing it down. Where did it find support? It found support at the smart money buy level at that 91.38 mark. So this is incredibly important to know. If you don't know where structure is inside a particular chart, you're just guessing. You could imagine looking at a chart like this and saying, well, why did it stop there? And why did it find support there? And why did it spend so long under there? Everything is actually explainable because of CTKS structure. That is, when you pop on the indicator, you'll see exactly what's going on inside the engine. And please note, prices are going up on the monthly service. From the 1st of October, prices are increasing. This is going to be your last chance to get a foundation membership and lock in a very low price and say no to inflation because it will be stuck at that price so long as you're a current member. Here we can see gold. It's going to be marked up with the CTKS method since 1833. And what does the algorithmic lines show us? They show us that there was a lot of overhead resistance from the 1925 level upwards. If we looked at it from recent indicative price, we may think this is support down at 1921. Unfortunately, there is no support here. There was structural support just a little bit lower at that 1919 level, which managed to hold price and rebound it before, but it doesn't look like it's going to do so again. It looks like we're heading into the 1919 area, and the more associations you get, the more structural lines that hang together or group together, the stronger that underpinning support is. It's resistance when it's above price, and you just go to where price is. This is resistance, and all of these areas are resistance too. These are support levels down here. It's vitally important to know real and true support and real and true resistance. And that real and true must be based on all of price action, not just a little snippet of recent price action. Professionals don't do RIP, which is recent indicative price. Rule 215 is a good one. Know and have confidence. We know, we don't guess. This is a professional channel. It is not a retail channel. I invented this intellectual infrastructure, KS zone analysis, to help people to get into the professional mindset. When people first start, they start in the panic zone and the blame zone. That's zone 1 and zone 2, the retail zones. People enter the market because they think it's easy. They think it's certain. Why do they think that? Because people tell them it is, and it's not true. After blowing up their accounts several times, they understand they've gone through a process called diamondization. They've turned into diamonds, and they focus on their learning. They know certainty is just a con, it's a scam. Therefore, they shift to stacking of probabilities. They know and understand all charts are intercorrelated and interconnected. They look to structure. They make the percentages work for them. Therefore, they move into the make money rule zone. But making money and keeping money are often very different. You can get millions of dollars and you can lose it just as easily. The key is to keep it. How do we do that? The first key is just to simply be kind to yourself. It's also important to be kind to others and be a person of value. Why is this important? Because happiness and meaning and fulfillment, they're what ultimately matters in life. Life is a marathon, it is not a sprint. Financial markets will teach you each and every day. Therefore, learning humility and patience is absolutely critical. If you're not learning, you're just blaming. And if you're blaming, you're suffering the loss and you'll make it again because, unfortunately, you haven't learned what caused the loss in the first place. We all go through this process. That's why we say we win or learn and never blame. Not surprisingly, we have a rule for that as well. Rule 212 from the masterclass. Markets demand the tuition fee of losses. In Zone 1 and Zone 2, people think that they don't have to make losses. You make losses in order to learn. There are all sorts of losses that you can make. You can make the financial loss, or you can make a loss simply because you didn't go into a trade or investment. Losses are just everywhere. They cannot be avoided, but they can be learned from. You'll find that the majority of your losses will simply come from not understanding the structural levels on Tier 1, Tier 2 and Tier 3 charts. Gaining the capability to draw up your own structural levels is incredibly important. I mentioned before that we say we win or learn and never blame because we don't want to go into Zone 1 and Zone 2. Zone 1 and Zone 2 are where the lose money rules are applied. We don't want to do that. It's too expensive. Instead, we become learning machines. And the thing to remember, every single trader and investor goes through Zone 1 and Zone 2 in order to get to Zone 3. Nobody gets to Zone 3 without going through Zone 1 and Zone 2. If you identify in Zone 1 and Zone 2, don't worry about it at all. You're in good company. Everybody has gone through it. But it's a choice to stay there or to promote yourself into Zone 3 and Zone 4. The key to that door is to drop blame and take up accountability. Now, how do we do that? If you make a loss or things don't go your way, look to create a personal rule. As an active learning thing, why don't you pop down what rule that you find, a personal rule that you've found to be the best, or it could be a rule from the masterclass, that's okay too. Sometimes it's pretty hard to understand what zone we're in. If you're impatient, if you just want to jump in and not do any background research, the probability is that you're in Zone 1 or Zone 2 and not Zone 3. Zone 3, we put in the hard work because we don't want to suffer the losses. When people first start trading and investing, they'll look at something and they'll say, oh, the price has gone up. Okay, therefore I'll get in. They don't even look at the chart. They just look at the price. Please, if you're doing this, make sure you look at the chart. And I don't mean a chart like this. I mean a real chart, a TradingView chart. And you can get TradingView for absolutely nothing. The greatest gainers in the past 24 hours: FRAXshare, Link, Maker, Aptos, GMX, Clayton, Bitcoin Cash, AVAX, and Injective. The greatest losers past 24 hours: Top 100, Render, Algo, Comp, Ton, Lunacy, XDC, Rose, HT, and Mina. As we know, all markets are intercorrelated and interconnected. We can see that Bitcoin is currently under a resistance level. It hasn't had a lot of opportunity to get above this level, but the key is to understand what structure is actually doing. Are we sitting on a mountain of smart money support through this area, or are we under a mountain of resistance, or does it look like something else? When we zoom in to price action on Bitcoin, and this particular fingerprint will be playing out on the alts. For example, if we look at Solana, it came up as Bitcoin came up and it came down as Bitcoin came down. And now it's going up because Bitcoin is going up. A lot of people don't understand that no alt can escape Bitcoin's gravity. What about Ethereum? It came down as Bitcoin came down. It had a slight reprieve, came down, and is now going up. Of course, this is on the daily basis, but the concept is no alt can escape Bitcoin's gravity. Let's zoom in a little bit more and now have a look at where the structural levels are. We can see that we've got a couple down here just below Bitcoin's current price at 26,296. There's one slightly above at 26,333. If we manage to get above these, we're heading to the next structural resistance at 26,565. But if we don't get above, we're heading below. And this is a bit of a fresh air gap. Ay caramba, look at that. That's a bit of a worry. 25,366. This means it's very important for Bitcoin to hold above these structural support levels as they exist in market at the moment. And you can learn to draw these levels up yourself. These dotted lines are called SLs or Stanfield levels. They are formed through the standards-based process of the CTKS method. Having been inside financial markets for nearly 40 years, my focus is to fast-track your knowledge. Becoming professional just simply means that you look at more charts than the ones that you put money into. You ignore recent indicative price and the news. You're aware of it, but you ignore it. Instead, you focus on structure and price reality. Always have your three-dimensional risk management and your rules playing out. When you've looked across the Tier 1, Tier 2 and Tier 3 charts and done your analysis, then you get in or out of positions. Retail FOMOs all over the place. Professionals take their time. We go slow to go fast. Keeping a positive mental attitude is really important, so that's why we have the CTKS Creed. We say to ourselves as a positive affirmation, I am dedicated and committed. I win or learn and never blame. Opportunities in life reset daily. And we know the universe wants us to succeed, so we can show kindness, integrity, and gratitude each and every day. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.